Hello everyone, it's Elliot Yu here. Now it's been over a week since the start of military action in Iran, known as Operation Epic Fury. The Strait of Hormuz has been effectively closed, with tonnage traffic down some 90% from what's considered normal. Now in normal times, you get around 15 million barrels of oil a day and an additional 5 to 6 million barrels a day of other liquid petroleum products moving through the strait. And that amounts to right around 20% of global oil consumption. Now, Iraq has also slashed production as its storage facilities were the first to fill up in the region due to the lack of an export outlet through the strait, right? So Iraq only normally has 3 to 5 days of excess storage capacity. So they hit that wall by the middle of last week and had to stop producing. Now, Kuwait has declared force majeure. They have more storage than Iraq, about 2 weeks of capacity, but they're still slowing production and refining output to avoid the higher costs of a more sudden stop. So they're kind of reducing gradually. Both countries would likely take significant time to restart production even once the situation normalizes, at least getting back up to their full production and export capacity. Now, Saudi Arabia is a little bit better off because they have an east-west pipeline that can move up to around 5 million barrels per day of oil from their oil processing and storage facilities in the eastern part of the country to the Yanbu export hub on the Red Sea in the west. Normally, that pipeline only runs at 50% or less of capacity, but they're ramping up to 100%. Still, that's not even close to enough capacity to handle all of Saudi's exports. Now, financial markets have had a full trading week, a little over a full trading week, to react and seek to discount the incoming news that we're getting out of the region. And we're seeing some really dramatic moves, right? Including, of course, a more than 12% spike in oil prices on last Friday, which was the final trading day of the week, of course, to over $90 a barrel. And since then, when markets reopened Sunday evening, that was March 8th, both West Texas Intermediate, WTI, and Brent crude oil prices spiked to just under $120 a barrel. Though we've retraced much of that and are back under $100 a barrel at the time I'm recording this video. Now, if you're like me, your inbox has probably been flooded, stuffed full with talking heads or pundits pushing narratives about a potential spike to $250 a barrel, and of course the usual array of geopolitical conspiracy theories and opinions about what President Trump or Iran's regime will or should do next. I'm not going to add to any of that geopolitical commentary, noise in this video, for the simple reason that it's a distraction and it won't help you make money in energy markets in coming weeks. In fact, I think it could actually cost you money in coming weeks, some of these narratives out there. Instead, my goal today is simple. First, I did send out a very long, detailed written analysis of the situation on Sunday, March 1st, including some of the key indicators and charts I plan to watch as markets reopened. That analysis is still very much in play, even though it's only over a week old now. So my plan for this video is actually to cover just a few trends I'm watching right now and send out more updates in coming days as things change, which they will. Today I'm going to focus mainly on points I did not cover in my March 1st update. So this is sort of an addendum and a little bit of an update rather than a totally new video or totally new outlook. The bottom line, which I'll get to in a moment, is that the recent action in Iran is accelerating the longer-term energy supercycle thesis we've been talking about for 18, even 24 plus months now. The trends were already underway, and as I've said before in videos and written pieces last year and earlier this year, the world has been sleepwalking into this crisis for some time now. The difference is that we're now seeing the changes in rapid fast forward motion rather than sort of normal speed. And that's bringing the energy crisis, and specifically it's really an energy underinvestment and supply crisis, forward by roughly 6 to 9 months. From a practical and tactical perspective, we've seen some tremendous gains in energy stocks recommended in this service this year. And many recommendations are now trading well above our buy-under prices, or recommended buy-under prices in the service. So we're also eyeing some shifts in our model portfolio recommendations in the week ahead, both to book some profits in some areas and reposition for the next wave of this cycle and this energy crisis that's underway. To paraphrase the old saying, a chart is worth 1,000 words. So let's start with this. Now, this is a chart of the spread in prices between U.S. traded West Texas Intermediate crude oil futures and London traded Brent oil futures. Specifically, you're looking at the price premium for Brent over WTI since the end of 2010. So we're going back a long way here. Now, Brent is the key international oil benchmark, and West Texas Intermediate is the key U.S. oil benchmark, and it's the one that underlies the NYMEX traded oil futures and options contracts. Now, as you can see, the weekly average over this entire period, well, it's about a $6.50 barrel premium for Brent over WTI. I've drawn horizontal lines at $4 and $5 a barrel because that's the rough cost of moving a barrel of oil from the United States to Europe on a tanker. If you look at the hard right edge of this chart, which is updated through Friday's close, you'll see that the premium for Brent over WTI collapsed last week to under $1.80 a barrel, and that's by Friday's settlement. So here's a close-up of this spread since late last year, so you can get a better look. What's interesting here is that at the end of February, just before the start of Epic Fury, Brent was trading at a price premium of about $6.50 a barrel over WTI. Now, on Monday and Tuesday, March 3rd and 4th, after the start of Epic Fury, so after the markets already had a chance to react to that news, the premium actually increased slightly to around $6.75 to $6.85 a barrel. Late last week, however, it collapsed. On Thursday, March 5th, the spread fell to $4.40 per barrel, and on Friday, March 6th, it fell all the way to $1.79 a barrel. Now, on Monday, March 9th, when I'm recording this video, the Brent premium to WTI has been all over the place, though it's generally been well under that $4 to $5 transportation arbitrage range I just outlined. So why is this important, and why the sudden shift late last week after the market already had a few days to digest the Iran news? Now, as I said, WTI is the U.S. oil benchmark, and Brent is the key international oil benchmark. Specifically, the official delivery point for WTI that underpins the NYMEX futures contract is Cushing, Oklahoma. So you can take a look at this map and see where Cushing is in relation to Texas, the Permian Basin, and all of the major refining and export infrastructure on the U.S. Gulf Coast and further south into Mexico. So WTI is an inland oil benchmark, and Cushing is a major pipeline interconnection point and storage facility in Oklahoma. And it's about 489 miles from the U.S. Gulf Coast. So these days, Brent is actually not just one type of oil. It's several different types, including, starting just a few years ago, actually, U.S. West Texas Intermediate, WTI. Except instead of WTI delivered to Cushing, Oklahoma, this is WTI delivered to Europe. So here's a map showing you some of the main delivery points across Europe for Brent. My apologies, as my artificial intelligence tools and we kind of had to move the North Sea out into the Atlantic, which of course is not where it's located, just so it would fit into this illustration. But I think you get the point. Brent is a waterborne oil benchmark with delivery points across Europe and the United Kingdom. So here are the actual delivery points in this table form for you to have a look at. So let's go back to the weekly slide of the Brent-WTI spread. When this spread rises and Brent gets more expensive relative to WTI, the market is sending a signal. Markets always communicate through price. And it's sending a signal that it wants to attract more U.S. oil into the Brent market. More U.S. exports are needed to supply the global Brent oil market. When the spread is well above that $4 to $5 a barrel transport cost range, that means U.S. producers have an incentive to export oil to Europe to take advantage of those elevated Brent prices relative to WTI. So not in absolute terms, but on a relative basis. It will also tend to limit U.S. imports, right? Because as U.S. refiners will maximize their use of cheaper domestic grades of oil, rather than paying up to import oil delivered by a tanker to the Gulf Coast. So as you can see here, prior to 2013, 2014, there wasn't enough U.S. oil infrastructure in place to export more oil to Europe. In fact, there was actually a U.S. law that prohibited most oil exports out of the U.S. The law was enacted in 1975, and it wasn't repealed until December 2015. So that means that U.S. shale production surged in this time. That oil was trapped or stranded in the U.S. And so the Brent premiums were much higher back then. Now after that, Brent premiums were lower, but still spiked at times, well above that $4 to $5 transport arbitrage range that I outlined. That happened in 2018, mainly because we had very rapid growth in U.S. shale production at that time, and a lack of adequate pipeline infrastructure to move oil from West Texas and New Mexico, the Permian Basin, to the Gulf Coast. So that depressed WTI prices relative to Brent. So the expanding margin was more about WTI prices being low and Brent prices being sort of higher, more normal at that time. Now it happened in 2022 again, in the early months or opening stages, if you will, of the still ongoing, Russia-Ukraine conflict. As the global market needed to attract more U.S. supply, that caused Brent prices to rise faster than WTI. So these were all big jumps in the spread that I'm telling you about, not declines. And we've actually seen a big spike lower, a big decline last week. So here's why that's crucial. This collapse this past week is the market's way of conveying the opposite signal to what I just told you about. The decline in the normal Brent premium, so lower Brent relative to WTI, is due to the fact that U.S. oil prices, again, that's WTI, rallied faster than Brent late last week, in the second half of last week. Now, both markets traded significantly higher, but WTI kind of caught up to Brent. So this is the market's way of telling U.S. oil producers to keep more production at home here in the U.S. Now, there are a number of implications from this dramatic move. However, let's focus on just two. Towards the middle of last week, the market began to price in increased probability, a much larger risk, that the disruptions in the Strait of Hormuz will last longer than expected earlier in that week. Okay? So the price of WTI needed to rise relative to Brent to ensure, basically, that foreign refiners desperate for crude and unable to secure supply from the Middle East now wouldn't be able to pull barrels via exports out of the U.S. This is how price signals work. You don't need to pass a law, banning exports. Price will do it for you, and that's exactly what we're seeing. Now, the second point, which is maybe less important in the short term, but I think long term more important. The market realizes that there will not be a sufficient production response from the United States, a jump in shale oil production specifically, that's fast or large enough to offset global supply disruptions. This latter point is important because, as you might recall, and as I'll discuss here in a little bit more depth in a moment, one of the main arguments made by the oil bears in recent years is that U.S. oil production would continue to grow significantly over time, and that thanks to rapid efficiency and technology improvements, right, U.S. producers can essentially manufacture more oil from shale at will. Okay, as for that second point, take a look at this chart. This chart actually shows the Brent and WTI future settlements out through June of 2027. So these are actually contracts for delivery of Brent oil, which is the blue line here, and WTI crude oil, which is the orange line on this chart, in each month from April 2026 through, I think I put June of 2027 here. All pricing is based on Friday's futures settlements. And as I said, things are changing very rapidly early this week, but the main picture looks about the same. The green bars show the spread. That's based on the right-hand scale on my chart here, the right-hand axis. This is the premium in dollars a barrel of Brent over WTI. Now what's interesting here is that the Brent premium actually turns negative, so Brent is cheaper than WTI in the second contract month I've got on this chart. So that represents the May futures for WTI. We're currently trading April futures. And we're comparing that, though, the May futures in WTI to the June Brent futures. Now, there's a reason for that. I set up this chart this way because the last trading day for May WTI futures is April 21st, right? And for June Brent, it's April 30th. So you have to kind of skip forward a month on the Brent contract to make it comparable to the trading schedule for WTI. So that's the most, so comparing May to June is the most comparable contracts for assessing this spread. Now the time scale at the bottom of this chart refers to the WTI contract months. So the comparable Brent months would be pushed forward 1 month. Now after May, however, what we can see is a gradual normalization, right? By September or October of this year, that Brent WTI spread in the futures curve is back to around $4 a barrel premium of Brent over WTI. So this suggests that the market is looking for the global market to remain tight through this coming summer to the point that there's a strong price signal to discourage WTI exports out of the US. Again, this is also a sign that the market realizes that there's not going to be a near-term surge in U.S. production of the magnitude needed to rebalance the global oil market and save the global oil market. Please note that this does not mean that the Strait of Hormuz will be closed this entire time. It just underlines the fact that even when we do get a return to more normal traffic through the Strait, it will still take several weeks for global production, tanker flows, and storage to normalize. So this indicator points to continued restricted oil exports through Hormuz for at least the next few weeks, with a gradual normalization into the summer and early autumn. So I have a couple of additional related points to that, specifically as it relates to the U.S. oil market and how the U.S. oil market relates to the global oil market. So first up, U.S. oil storage is actually really low right now, particularly at that Cushing, Oklahoma hub. This first slide shows total U.S. oil inventories excluding the Strategic Petroleum Reserve, the SPR. So far this year, and that's the blue line, the green, orange, and light blue lines show the 5-year seasonal max for storage, the 5-year seasonal average, and the 5-year seasonal minimum. So current U.S. oil commercial inventories are tight, below that 5-year average in the lower half of this range. And so this is the exact same chart I'm throwing up on your screen now, but just for Cushing, which again is important because it's a delivery point for NYMEX WTI futures. Now generally the conventional wisdom is that tanks at Cushing need a total operating minimum of around 20 million barrels. And so below that, you can actually see damage to some of the tanks because they have floating roofs, right? And so when the level of oil in the tanks gets too low, that roof actually rests on the support legs. In addition, some of the pumps used to move oil out of storage would actually be above the fill level of the tanks if you get down to that 20 million barrel a day level. And so we're actually not too far above that operational minimum right now. As of the most recent report, we're at just under 26.5 million barrels, which shows, and this actually shows the level at the end of February 27th, this data is of, which is the most recent data we have from EIA. And that's of course before the start of Operation Epic Fury. While we did see a surge in inventories right at the end of February, we're still below the 5-year average on both a total basis and if we just look at Cushing, of course, as well. So given the current disruptions, it's going to be very hard, very difficult for U.S. storage to fill to more normal levels as we move into a period of peak demand for oil in the summer months. One more point to keep an eye on as it relates to the U.S. oil picture. And back in January, some of you may remember, and it's out there, I sent you a video and also published several written alerts regarding the U.S. military action to remove the de facto leader of Venezuela, the dictator of Venezuela, Nicolas Maduro, to remove him from power and ultimately capture him and bring him back to the United States. Recall that one of the most common media narratives out there at the beginning of the year when this just had happened was that Venezuelan crude was tough to refine, heavy, I heard it called sludge, that had very little value. And I pushed back on that in these videos and alerts, explaining that heavy Venezuelan crude is actually exactly what U.S. refiners need. So let me just give you the executive summary. U.S. shale oil production is very light, sweet crude oil. So it's light, which I'll tell you what that means in a moment, and sweet just means low in sulfur content. But U.S. refineries are actually set up to blend a mixture of light sweet and heavier and heavy sour, so heavy in sulfur, crude oils to optimize their output and the economics of running those refineries. So easier access to Venezuelan crude supply actually was something of a windfall for U.S. refiners. Now, a related question to consider is simply, what is oil? Okay, now I'm going to apologize in advance. I'm going to give you a little bit of a hit of a chemistry lesson. I promise not too long. So in its most basic form, crude oil is a mixture of hydrocarbon molecules. So these are molecules of hydrogen and carbon of different lengths. So chains of hydrogen and carbon atoms. So the longer the chains, basically the heavier the oil. Okay, there are also other hydrocarbons besides oil, quote unquote oil, that are usually found mixed with crude oil in a field like the Permian Basin of Texas. So natural gas, or methane, is actually CH4. So it's a single carbon atom bonded to 4 hydrogen atoms. Okay? You also have ethane, or ethane, I think is how it's generally pronounced on the other side of the Atlantic in the UK, is actually C2H6. So 2 carbon atoms bonded to 6 hydrogen atoms. You have propane, C3H8. You have butane, C4H10. Now those last 3, ethane, propane, and butane, are known collectively as natural gas liquids. Now, methane and ethane are gases, while propane and butane are gases at atmospheric pressures, but actually become liquid when you compress them slightly or at subsurface pressures. So the reservoir pressures are obviously a lot higher than atmospheric pressures on the surface of the Earth. You may have also heard the term condensate or liquid or natural gasoline. This mainly refers to pentane and hexane. So these are C5 and C6, so 5 and 6 carbon atoms respectively. Though natural gasoline or condensate also usually contains smaller quantities of longer molecules like C7s and C8s. Okay? So key U.S. shale fields like the Permian contain a lot of associated natural gas, CH4, natural gas liquids like ethane, propane, and butane, and condensate, which is again that C6, C7, and a little bit more, as well as, or C5, C6, and a little bit more C7, C8s, as well as this short chain hydrocarbon molecules. So these would be what would be known as really light or even ultralight crude. So the Permian is what's known as a stacked play, which just means that there are multiple productive layers of reservoir rock, layers that'll produce oil, natural gas liquids, natural gas, and a mixture of hydrocarbons that are under the surface. So producers in the Permian, they drill a vertical well element, but then they drill these horizontal wells through these productive layers, and that's what actually produces the oil and gas through that wellbore. But over time, the play is actually getting gassier, so higher natural gas content, and lighter. That's very important, lighter over time as the play matures and as producers work through the easy oil. So basically what that means is these are their prime, most economic drilling locations, right? And the locations that tended to produce more, in many cases, more of that, those slightly heavier, often still light crude oil, but slightly heavier, longer chains of hydrocarbon molecules. So I think there's a tendency for people to hear, how much oil the U.S. is producing. We're the world's largest oil producer. Or you might hear an energy firm talk about how much they plan to grow their barrels of oil equivalent, or BOEs, of production, and assume that the U.S. is just totally awash in oil. However, you got to remember that the term BOE, barrels of oil equivalent, includes volumes of natural gas, right, and natural gas liquids. And even the crude oil bit, right, often includes some condensate volumes and those very light and ultralight crude oils. So you can actually see this issue play out in real time. Not all of this is exactly the same thing as what we've traditionally thought of as crude, right? So the blue bars on your screen right now represent the average price of West Texas Intermediate crude oil in each quarter from Q1 2024 to Q4 of last year. Okay, I actually sourced this data from some of the producers out there that record this data. This is actually the average settlement price of oil in those quarters. Okay, I've also included data for Monday, March 2nd, right? The settlement on Monday, March 2nd, that was the Monday that oil markets reopened after Operation Epic Fury kicked off, and also Friday, March 6th, so Friday of last week. So the orange bars include the price of a mixed barrel of NGLs, what we sometimes call Y grade, which by industry standard is somewhere around 40% ethane, 25% propane or more, and a little under 20% butanes. So it's less than 15% condensate or natural gasoline. The green line there shows the value of a barrel, that's 42 gallons of mixed NGLs, relative to a barrel of West Texas Intermediate. So what you can see here is at the end of last year, at the end of 2025, a barrel of NGLs was worth almost 40% of a barrel of oil, of West Texas Intermediate. And for many years, 40% to 50% was kind of considered normal. So NGLs traded at 40% to 50% or even higher of the price of a barrel of WTI. So even at the beginning of last week, that was still up around 37%. But late last week, that plummeted to more like 30 to 33%. The low end of the range, as you can see here, that's that green line again, since early 2024. So the value of those NGLs, including some of those condensate and natural gasoline volumes that often get lumped in as oil, is falling relative to benchmarks like WTI and, of course, by extension, Brent. So my point, one I've made a lot in recent years, including back in my January barrage of Venezuela-related updates and videos. My point is that I think a lot of oil bears point to the growth we're seeing in volumes out of places like the Permian Basin, or liquid volumes out of the Permian Basin. Or they'll point to things like Exxon's strategic plan to grow their oil production by a fair amount, actually, through 2030 and beyond, and deploy all sorts of new technologies, right, to leverage, even leveraging the power of AI, artificial intelligence, to drive down costs. Exxon talked about that a lot on their January conference call, which those of you who are interested, I would encourage you to go check it out. It's something I've written about a lot in this service. But the bears are ignoring what Exxon is actually producing. It's some oil, to be sure, but there are also significant volumes of natural gas, liquids, natural gas, and ultralight crude oils in those BOE numbers. If those light hydrocarbons, that ultralight crude oil, condensate, and certainly ethane, propane, and butane were the same thing as oil, if all liquids were the same thing, just because they're all hydrocarbons, then you wouldn't see the value of a barrel of natural gas liquids plummeting relative to WTI right now, which is exactly what you saw on that chart I just showed you. When you consider the molecules being produced alongside the physical quantity of production growth, that endless glut narrative we heard about so much last year falls like a proverbial house of cards. This is also why Venezuela's heavy sour crude oil is a lot more valuable to the U.S. than some of those media narratives about sludge might have suggested earlier this year. Please understand that I'm not saying that America's massive and growing base of oil, natural gas liquids, and natural gas production isn't valuable. I'd actually argue the opposite. I think it's one of this country's biggest economic advantages right now, including in the development of AI, which of course requires a lot of energy and a lot of that's going to come from natural gas. American oil extraction technologies and their leading energy companies like Exxon, without a doubt, are without equal in the world, I would say. What I am saying is that American oil production is light, and it's getting lighter and gassier. And the argument that oil prices will remain low because growth in Permian production, obviates the need for developing new oil production projects from other places around the world, including the Middle East, it's totally naive. Now, don't just take my word for it. You can see it in the hard numbers I just presented. We're seeing a test of this endless US-based glut of oil in real time, and the hypothesis of an endless glut is being rejected in actual real time right now. So with those points in mind, let me back up for a second and lay out, what this all means for energy commodities and energy stocks. So late last year, Wall Street was very bearish on oil. And so were speculators in the oil futures and options markets. And we can see that in the weekly Commitment of Traders report that I wrote about as recently as last week and many, many times over the last year. So groups like the International Energy Agency, IEA, were talking about a super glut of oil through the first half of this year, pointing to rising U.S. oil production, which I just talked about, and a huge quantity of floating storage, which I talked about a lot in last week's updates, which includes as much as 200 million barrels of sanctioned Iranian and Russian crude oil on tankers, mainly in Asia. Now, much of it is actually parked off the coast of Malaysia. They were also talking about rising OPEC production and OPEC's spare capacity, ignoring the fact that most of OPEC production growth since last September and October has been paper barrels, not an increase in physical volume. So OPEC has said, we agreed to raise production by X 100,000 barrels in the next month, but they're only doing a fraction of what they said because the only countries that actually have spare capacity are really Saudi Arabia, UAE, and a couple of others. Also, they're ignoring the fact that, only a handful of these OPEC producers, Saudi Arabia and UAE, have real spare capacity. That's actual production that can be brought online within 30 days and sustained for 90 days or more. What's really interesting to me is that through all the bearish rhetoric, energy stocks like ExxonMobil, shale producers like Diamondback Energy, started outperforming oil in the late summer and early autumn of last year, so some time ago. In fact, the S&P 500 Energy Index was a huge laggard in the S&P in the first 9 months of last year, but is now a top-performing sector. Through all of this, our argument since last summer has been that the rally in energy stocks reflects the market view, that the supply-demand balance in oil was gradually normalizing despite all the super glut narratives out there and IEA predictions of 4 million barrels a day of excess global oil supply in the first half of this year. That's because while oil prices were low in late 2025, energy stocks are always looking ahead. Energy companies, their valuation isn't based on the price of oil today or the price of oil next week. It's based on the average outlook for oil prices over the next year. That's another reason why you haven't seen the prices of energy stocks like Exxon or companies like Diamondback rally much over the last week, despite this super spike we've seen in WTI and Brent crude oil to near $120 a barrel overnight. They were rising since last summer, though, because market participants didn't expect oil prices to remain as depressed as they were back then. Now, the bearish arguments, in my view, have always rested on very shaky ground. While floating oil storage of sanctioned barrels was elevated, commercial storage, particularly in developing OECD countries, was very tight. I just showed you that with the US. While US oil production is growing still, it's growing at a fraction of the pace it was during the shale boom years. And as I've pointed out and analyzed in prior issues, production from most US shale fields, like the Bakken Shale, for example, really even in the Permian Basin outside of Exxon in the Delaware Basin of West Texas and New Mexico, which is part of the Permian, was rolling over through late last year because low oil prices discouraged drilling and production activity. Meanwhile, a lot of the growth people are talking about is actually very light oil or even barrels of oil equivalent, rather than just actual barrels of crude oil, which, as we've seen, it's not exactly the same thing. Our view was that it would take into the second half of this year or even into early 2027. This is something we wrote about a lot in our year ahead outlooks at the end of 2025 and into early January of this year. Our outlook was for it to take into the second half of this year or even again into early 2027 for the oil market to actually look more balanced from a physical supply and demand perspective. And energy stocks were basically rallying in anticipation of that. And I also thought it would take well into the second half of this year for market concerns about rising OPEC production to fade as the cartel continued to fall well short of announced production increases. But what's happening right now is accelerating all of this. The United States granted India a 30-day waiver just this last week of sanctions on Russian oil. So that's allowing India to import sanctioned Russian oil barrels that are in floating storage. So they're going to be pulling in some of that floating storage. And it already appears that those stranded Iranian barrels, mainly floating off the coast of Malaysia in tankers and sanctioned tankers, are starting to be pulled into China as imports. So that floating storage overhang could be totally gone by this summer, if not sooner. It's possible we'll see an additional spike in crude oil prices and front-month crude oil futures the longer the Strait of Hormuz remains closed, because demand for oil is inelastic, right? Which means that it's hard to find near-term alternatives to oil. It's pretty much impossible. So the price of oil needs to jump a great deal to the $150 or $200 a barrel even, to levels that destroy demand when supplies are truly cut off. It's the market's way of rationing supply. However, I'm not calling for sustained $100 or even near $100 crude oil prices this year, this summer. As you've probably noticed, as I said, energy stocks haven't rallied much since late February, since before Operation Epic Fury. Many are actually trading down from where they were at the end of last month. Despite the big spike in crude oil and all the geopolitical headlines over the last week, that's a sure sign that markets see this as a short-term spike in oil, not a new normal. Also, as I just showed you today, the futures market is currently pointing to a more normal WTI Brent spread by late summer or early autumn. What's really important is 2 points. First, even once the strait reopens, oil prices aren't going to plummet back to the high 50s and low 60s levels we saw late last year. It's not going to happen anytime soon. It will take time for oil production and export volumes to normalize, and the floating storage the bears have been worried about, it's already draining. It's a guesstimate at best, but WTI for delivery in October is trading in the low to mid 70s right now, and it was trading just ahead of the start of Epic Fury. It was trading in sort of the high 60s, low 70s. So I think that's the new floor, and oil prices will actually need to be more like $80 a barrel plus longer term to incentive capital spending to bring on new supply, or incentive producers like Diamondback, for example, to increase their drilling activity enough to maybe grow production into 2027 and beyond. The closure of the straits is also serves as a reminder of just how tight the global oil supply and demand balance can be, right? And how rising light and ultralight U.S. crude production can't ramp up quickly to offset supply disruptions, particularly for heavy barrels, all over the world. The problem remains that the world has underinvested in new crude oil production projects for most of the past 10, 15 years. And the global decline rate for mature fields is accelerating. Modest growth in U.S. shale production isn't going to fix that. Oil prices will need to rise to levels that encourage greater production, more capital spending. And that's not $60 a barrel. And it's certainly not the $30 or $40 a barrel level that I heard some people talking about late last year. So I know we've covered a fair amount of ground in this video. And if you want to know more about what's happening and my expectations, I'd point you to the long written piece we sent out last week and some of the videos and written updates we published earlier this year. Just make sure you're subscribed to the service to receive our free alerts as they come out. And if you want to know exactly and see exactly in real time what we're recommending in terms of actual recommendations, stock recommendations, and their shorter term outlook, or if you want to ask specific questions about all this, I am offering free trial memberships to the paid tier of this service via the link below this video. Thanks again for listening, and I hope you found this useful. If you did, please drop me a like or a comment. It really helps us out with the engagement metrics. So thanks again. Again, my name is Elliot Gu. Thanks for listening.